Welcome to Boston University's Real Estate Club Guest Speaker Series for conversations about real estate, leadership management, and people who have achieved something in our society. Jeb Belford is certainly that. He's an equity owner and managing director of Clarion Partners, which is one of the world's leading real estate investment firms with $63 billion in assets under management. Jeb, it's an honor to have you here with us tonight.
Well, thank you very much. Thanks for having me.
You studied mathematics and religion at Dartmouth College in the early 1980s. Shortly after joining Boston-based real estate syndicate, Winthrop Financial Associates, to kick off your long and impressive career in the industry. Your background in real estate is quite dynamic, including portfolio management, acquisitions, and financing, as well as sales totaling over $20 billion across all property types, risk strategies, and markets such as the US, Brazil, and Mexico. When thinking about the beginning, how did you discover your passion for real estate, and what was your career progression like within your 11 years at Winthrop?
Well, to be honest, I fell in love with real estate on the job. I knew nothing about it before I actually started. I was lucky enough to get a job at what I thought was a really interesting firm with a lot of great people. And I've been lucky in both firms I've worked for to be surrounded by that my whole career. When I started as a lowly analyst in the acquisitions group, which is kind of a normal way to come in. And spent 2 to 3 years sitting behind my computer, going nowhere and working endless hours and running numbers on transactions. I then got a chance pretty early on to move down to New York and work on a portfolio of assets we'd acquired, office buildings down in New York. And that's kind of an unusual career move. Nobody would really consider going from the investment side to the property side normally today. But I always found that to be invaluable because I actually got to see how the properties really ran. And you got to be really close to the leasing of them and the operating part of them. And I think that's really important ultimately to being a good investor is really understanding how it works. And I never would have gotten that sort of on, that close, relationship to that if I had not done that. After a couple of years down there, I moved back to Boston, back into acquisitions at a little higher level, did a little time in asset management when the acquisition markets were a little quiet, and spent a little time in portfolio management as well at Clarion near the end of my time there, working on a couple big assets that we owned for a big institutional client. So I got to do, a bunch of the different disciplines in a business like ours, all in that first sort of stint. And it wasn't terribly engineered. But again, I've always felt fortunate that I got to do all those different things early on because it, in my mind, set a really good foundation for, being more effective later.
Would you be kind enough to explain Clarion's platform to our audience members?
Sure. We are a firm that's invested in real estate for about 40 years now. That's kind of all we do. It's for the most part investing on the equity side as opposed to the debt side, although we do a little bit of that. It's almost entirely been in the US, although we've done a little stuff outside the US and Latin America. And currently we have much smaller group that's investing in Europe. We have as you noted, we have I think it's about 65 billion of assets under management now. That's probably an updated number from the last one you saw. And we invest all across the major property types. So to us, that is office, apartments, industrial, and retail. But we also invest in some of the smaller property types. And we do it across the risk spectrum. We have core long-term hold strategies, and we've got value add strategies, and we've got some more opportunistic strategies. We also do it in the form of funds, commingled funds, in which lots of investors choose to own a part. And then we also have some very large individual separate accounts, large institutional investors. Most of our investors are institutional, although increasingly lately, smaller, or what you'd call retail type investors, are finding their way to us in various channels. But for the most part, our clients are institutional investors that want real estate as part of their overall portfolio. And we're one of the firms that provides a solution for that. Maybe I'll pause there and see
Great.
where you want to go.
Thank you. Well, I think I have a good idea about an interesting fund that you're involved in. So let me ask you this. You spent the last 9 years of your career running one of the largest open-ended, diversified US funds and turning it around to be a top performer. When taking this fund over in 2013, what did you think you needed to do there? And what did you do?
Everything.
Love it.
So, the fund had been around inside Clarion for about 13 years already. So it had some seasoning. It was a very average performing fund. And in my view, it needed a new and fresh strategy. I mean, I took it over coming out of the global financial crisis also, which in retrospect was a good time to kind of set a new course for something because things were changing in the real estate world. But I think I thought it needed a new strategy. A whole bunch of parts of the portfolio needed to be sold and new stuff needed to be acquired. I thought we actually needed to change a little bit of the attitude among the team. And I've always felt like if you want to be really good at something, you got to try to be the best. You may not be the best all the time, but if you want to be really successful, you got to try to be the best. And the fund competes in a very competitive space. There are 25 other funds in an index that's called the Odyssey, which means open-end diversified core equity index. So investors there have a lot of choice. They've got plenty of choices of where to put the money. And unless you're really good, you're not gonna be one of the ones they think of. So, in my mind, my goal was get the strategy right, change the portfolio up to match that strategy, set an attitude where we want to try to be one of the better or best funds. And it took probably longer than I expected to do that, but that sort of seems to have worked out kind of in the end. The fund has been fortunately to be a very good performing one in its group. And that did eventually attract a lot of attention, and we've been kind of on a roll.
Well, congratulations on its success thus far, Jeb. Truly. When looking back, what was easy and difficult about all your endeavors with this?
Well, with that, it was easy in my own mind to see where I thought I wanted to go. It was harder to make sure everybody else was on board. There's in almost anything you do, there's an inertia, right? So if something's been done some way for a while, there's always nervousness about changing that up. So I couldn't go say, hey, we got to sell half of this portfolio, right? Nobody would have wanted to hear that, but that's what I actually thought, right? So gradually getting people around and on board with what you're doing, whether it was internally or outside investors, is a lot harder than you think it is, and it takes a lot more time. You got to really sort of do it and prove it to them before people really jump on board, and that surprised me. Well, that was probably one of the harder aspects. And it's also hard to change a little bit of your own mindset. If you got a whole bunch of people that are kind of working along one track, and then to come in and try to change that up in attitude and execution and hard work or whatever metric, it's not easy to do that either. It takes quite a while to sort of move people into a different mindset. So those I thought quite hard. The easier part was sort of, at least in my mind, seeing where I thought it ought to go. And the easy part was the goal. The goal was let's be one of the best in our competitive space. So, and the execution of doing what we do is hard anyway. So I wouldn't have said that was any harder or easier than expected, but it's still hard. But the day after day of finding investments, bidding on them, trying to win them, competing, in a very competitive world is just not an easy thing to do. So.
When hearing about the idea of enlisting others in your vision, it makes me think of a great leader. Would you mind giving us a little bit more insight into some of your personal leadership principles?
Well, I've always felt very strongly that you want to be very inclusive of your team in what's going on. Now, it can't be everybody, from the person that has one day on the job to 20 years on the job, but the more inclusive you can be in with your team and what's going on and including them in the thinking and the listening and the meetings and the decision making, whether they're helping make the decision or they're just listening, has always to me been very powerful, right? And people on the team love that, right? They really love working on something where they feel like they're really in the mix and they're learning. So that would be number one. Like, two, just be like brutally honest about everything, really, but especially about what's working and what's not working. Be honest with the people you're working with, be honest with your investors. They're going to respect, even if it's bad news, they respect the fact that you're dealing with them straight. That's a hard thing for some people to learn. It comes easy to others, but that I've always found to be like a really, really important lesson to learn yourself. Learn to, everybody's different. Learn to be yourself. Learn how to be effective in doing what you're doing, but like kind of do it your way. That doesn't mean you can just do anything, but it's kind of like finding your own voice. You don't have to be exactly like anybody else. And it's not usually effective to try to pretend like you're somebody else. So you've got to find a way to do what you do inside your own skin and your personality, and that's okay. Some people will tell you that's not okay, but that's okay. And then after that, it's you got to be willing to roll up your sleeves and do a lot of hard work. I think people respect that. Really respect that. They sort of really respect sort of seeing you do it alongside them, as opposed to just telling somebody what to do. Or people respect the people that are hardworking alongside them at the same level. So that would be another thing I would throw out there, is something totally to keep in your mind, and watch other people around you.
Now let's circle back to real estate again, and talk about a local deal. Clarion recently exited from Cambridge Highlands campus for $180 million. This property is just across the river from us. Can you tell us about your business plan and the execution of this transaction?
Yeah, so that wasn't in my portfolio, but I remember very keenly when we did the deal. I've spent a lot of time in Boston, and I'm one of the people that's known that market better than others. So, we're good internally about getting people that know something together to figure it out. And the theory there was that it was a great location. They're kind of crappy buildings, no offense, with a really good tenant at the time, with a pretty decent amount of term and they were utilizing that facility. But we thought it was a great location in a changing part of the market. A lot's happened over there, what we would call West Cambridge, right, or Alewife, and that whole area. And we kind of thought that area had a good trajectory. Cambridge is extremely difficult to build in, and good sites are hard to find. So we've got a good location. We've got a tenant in place for a while. All that sounds good, but the real game plan was, hey, if we can get our hands on this real estate, if the tenant ever leaves and we can get our hands on this real estate, and remake it, we think we can create a ton of value. So that was the original thinking, like credit tenant, decent amount of term, decent going in yield, great location. And if and when they leave, we think there's big upside. So they never left. The tenant never left. But in the time that we've owned that, the market has not only been very strong, but it has really had a huge extra boost, like other parts of Cambridge, from the whole life science activity.
Yeah.
And the center of life science obviously is East Cambridge, but West Cambridge and Watertown have now become another location. So the site has only become more and more valuable over time, notwithstanding that original tenant's still in place. So we've owned it for a while, and it's owned by an individual institutional client. And collectively, we thought, well, maybe because the market's so hot, it might be time to test the market and see what we could get for it and sell kind of the same dream that we had going into somebody else. And lo and behold, somebody came along and paid extremely high price for that dream. In this particular case, the buyer is hoping that they can get their hands on it and can turn it into life science space, which won't happen tomorrow. The tenant's still in place for a while, but they believe so strongly in that possibility that they paid us a really big number for it. So it was a screaming home run from start to finish, even though we really didn't do anything to it. But the lesson is that it's owning really good locations that are always going to be in demand or could have a really high probability of having even better demand in the future pays off. But the building's nothing to write home about. It's probably going to get scraped. There's nothing special about it. It's all about the location in this particular case, and in a lot of cases. But that's a fabulous location, and it's only gotten better, and we were lucky enough to kind of ride that one. So
Awesome. Thanks, Jeb. Now let's step out of Cambridge and go a little bit macro. How has the real estate industry evolved since the start of your career?
well, it's tremendously. So I started almost 40 years ago, and real estate was, a much smaller asset class in people's, and when I say people's, I mean really institutional investors' portfolio. It wasn't terribly well regarded in many instances. Kind of a place for cowboys and crazy people. And to some extent, rightfully had that reputation because there were a lot of bad actors or questionable actors in that space. So one of the biggest changes is that over the intervening time, the space has matured. It's gotten much better and more institutional quality. Firms like we think we are in as investment managers, it's proven that there are a lot of good real estate firms and people out there that over time have changed the reputation of the space into a very attractive institutional quality, well-run, worth investing in space. And that's been really gratifying to see. So the percentage of an investor's portfolio that real estate represents is way higher today on average than it was back then. And that's a sign that we've figured out how to make our industry better and mature. But it took a lot of firms doing a lot of hard work and proving it every day to get everybody there. But that's a really huge mental change that occurred slowly over that time. That's brought with it a lot more firms, a lot more competition, a lot more investors, a lot more to do, more property types to invest in. So everything's expanded dramatically since that early time into a much vaster universe of things to work on and different styles of investing. So the way you can invest today and the access that investors have is just dramatically wider than it was, back then. And again, it's sort of slowly changed over time. As far as kind of what you do, how you run an asset or how you underwrite an investment, not a whole lot different. Your assumptions might be a little different. Your expected return is certainly much lower today. I'll get back to that in a minute. But how you actually do your day-to-day job is not so different. But the overall quality of the firms and the people and the way it's approached mentally and as an investment class is just completely different. I would cite two other things. Information is really an important one. Information back then was hard to get and not very good. and everybody was super secretive. Like you don't share anything, right? Now the information on our space, which is generally comes from people that are in the third party information providing business, they make the business how that is actually really good for the United States. And everybody can kind of get pretty easy access to lots and lots of good information, which was really hard to get a long time ago. And that's even the playing field. That makes it harder, makes the competition fierce, makes it harder to find new ideas or different ideas because many people are seeing the same thing. And we've had to get used to that. But that's a really critical thing that's very different today than it was a long time ago. And I would say that there's really no place in the world that has anywhere near the level of information that's available in the United States, even other major investment markets like Europe and Asia. The information there is still really hard to come by. It's questionable quality, and that's kind of sets us apart and actually makes investors feel a lot more comfortable with our space. And then the last big thing I would say is that 40 years ago and 30 years ago, interest rates were a lot higher, inflation was a lot higher. The required return from something like real estate was a lot higher. So the required return from real estate has declined pretty consistently over time. We talk a lot about unlevered IRRs. So when I started, a core deal was supposed to produce an 11, right? That was what you needed to get. And if you had a 10.5, like it wasn't a good deal. And in the early 2000s, it sort of kind of slowly started coming down. Well, it came down to maybe 10. But then in the early 2000s, it kind of very fast pace went from 10 to 7. And everybody freaked out. Like, how can this be? How can we buy stuff down here? Like, real estate's not supposed to produce a 7, it's supposed to produce a 10. And it took a long time for people to really adjust to that and the fact that it wasn't going back. And the real reason for that is the returns from the entire world were going down. Like debt rates were coming down, inflation was coming down, what you'd expect from fixed income and equities were coming down. So it was a whole, lowering returns of the whole world that really, and we kind of went along with it. And a lot of people went along kicking and screaming. So today I would say core unlevered IRR is 6 maybe, and it's inching lower than 6 to 5.5 to 6 now. And even the difference between 7 and 5.5 to 6 is pretty big, but that's what the market is. So but also, rates and returns across many asset classes have also come down. So real estate's moved with it, but that's a big change. And if you're in that world, it's hard to sometimes adjust to that change when it's happening.
I'd like to spend some time talking about the markets in which you're active, North America and Europe. Can you talk a little bit about the current real estate environment across these regions?
Yeah, let me start with the US because that's the biggest and most liquid market in the world by a long shot, which is a little bit of a consistent with something I said a few minutes ago. But historically, so in the United States, we have 4 big property types that we kind of think of as core, 4 major property types: office, industrial, retail, shopping centers, and apartments. And we have a whole bunch of other littler property types, but we have these 4 biggies. And if you look back over a long period of time, sure, there are differences among them, but they generally kind of move in a band. Like they all behave kind of the same, right? And they smooth themselves out over time as far as relative to each other. But it's very rare that you have something going on in one that produces a completely different return as something else or other property type. And that really started changing. And this is it's a big new thing that everybody's adjusting to. But that really started changing post the global financial crisis. At first time, very slowly, but it kind of was picking up steam in 17 and 18 and 19 before COVID came around. But, and the simple one to talk about is, with the rise of e-commerce, all sorts of goods or more goods were flowing through the warehouse directly to us. Then we would go buy, and that would incrementally hurt stuff that we buy at the store. So all of a sudden, the sleepy industrial sector, which had been sleepy forever, all of a sudden became the super cool, hottest thing of all time. And, and its returns were dramatically higher than retail on the other side, which was really suffering. And retail has always been one of our before that was always one of our steadiest, you know, tried and true property types to invest in. So, you know, there was a big widening of returns between those two, with office and apartments kind of in the middle. And COVID just drove a ginormous wedge between everything. So, you know, it's really exacerbated trends that were underway, but industrial's killing it. Apartments are actually doing really well. Retail has been pretty weak. Office has been, you know, flat to weak because nobody has really figured out how we're going back to work just yet, or we got to really wait and see. So it's more of a question mark. But that kind of divergence in performance is really different and new, but that really characterizes our market right now. So you've got these really well-performing property types that everybody wants to be in. And you got a bunch of major property types that who knows, or kind of hope, you know, like weak or who knows, and nobody wants to be in them, or certainly doesn't want to buy any new stuff. So, you know, that's created this sort of big divide in how people behave and what you're interested in and what you can sell and what you can buy and what you can't sell and what you can't buy. You know, so that really characterizes our market. Different cities are a little bit different too. You know, New York and San Francisco have been more challenged in COVID than a whole bunch of other places, Florida, Texas, for example. So there are definitely different things going on geographically, but not quite as distinct as what's going on in the property types. And so what does that mean? That means that, you know, it's with a narrower playing field, you know, it's even harder to distinguish yourself with your strategy because everybody wants the same thing. It's much more competition. Historically, people would have taken the other side of the bet and kind of gone back to office or gone back to retail or gone to a less favorable city to get a little extra return, kind of knowing that everything moves in sort of a band over time. And like, that's not clear today. So we've got a super deep and liquid market. We've got as much interest in the overall market for real estate as we've ever had. So there's plenty of capital, but it's chasing a narrower field of things. And the good stuff looks like it's going to stay really good, and the weak stuff looks like it's going to stay kind of challenged. And you know, that's really a very interesting spot to be in. I would say, unlike earlier times, and earlier now is kind of back earlier in my career times, the real estate space is much lower leveraged. It was all a leveraged game 40 and 30 years ago. Real estate owners generally don't have overall that much leverage. So owners have staying power. You don't have to sell. There's very little distress. Even all through COVID, by and large, most tenants paid their rent. People are collecting their cash flow. For those that have debt, you can pay your debt service. So there's no real huge distress going on amongst owners. So, you know, and in, you know, previous really difficult times, you'd see a fair amount of distress sales. You don't really see that, right? So the space is pretty solid. The owners are generally well capitalized. We're not overbuilding our space, which is the big sin we could commit. So we're in reasonably healthy shape, like from a macro perspective, but with big differences going on inside our space. That's kind of characterizes the US space right now. So I guess the last thing I would say is that, you know, where you want to buy core is where you think the rent growth is going to be the best. And there are plenty of places where rent growth looks good and a whole bunch of places where it doesn't look so good. But it's also a development opportunity. So it's a good time to develop industrial into the tremendous demand. It's a good time to develop apartments into really great fundamentals. So, you know, you can play, you know, in existing assets and in more opportunistic part pretty effectively right now under the conditions we're in. You know, that's a little bit rambling, but that kind of characterizes, in my view, what our market's like today. You know, add in a zillion different people doing it. Like it's a wide industry group that do what we do. I would say that our general feeling is that, well, let me say one more thing. One of the things that makes the US more compelling than some other parts of the world is we're still growing, and growing just very simply demographically growing. So, and ultimately, real estate needs people. It needs people to live in it, to go to the office in it, to buy, buy goods at retail centers, and to buy goods that flow through warehouses and to occupy hotels and et cetera. So if you've got a growing population, you have inherent growing demand. And that's a good thing. But you contrast that with a whole bunch of parts of Asia and Europe where there isn't that demographic growth. So you don't have that sort of fundamental underlying, big picture, it's growing, so it's gonna be good type feeling. Consequently, you really have to be very careful where you're picking and choosing in Europe. I'll come back to Asia in a minute. Although we're not, take what I say about Asia with a grain of salt, because we're not uber pros at Asia. But Europe just doesn't have that same underlying growth dynamic. So you got to be really careful about where you're picking, because there are always growing places and not growing places. So you can always find places that are in good shape, head in the right direction, worth investing in. And it's just a little bit harder, in my opinion, in Europe than some other places. There are fewer major markets. There are more kind of thin secondary markets. But what we think is really compelling, which is the same story as here, is the rise of e-commerce and therefore the need for industrial, with the sort of a too simplistic statement that Europe is about 5 years behind us on that whole trajectory. So they're heading in the same direction. Same things, starting to happen. They need a lot more industrial space, and we think that's a compelling investment opportunity. It's reasonably compelling on the apartment side too. Although I, from my vantage point, investing in retail would just be as nerve-wracking there as here for the same dynamics. And office at the moment for the same dynamics too. I mean, COVID's obviously everywhere, so how everybody goes back, and how people occupy office space is a real question. So, so Europe has, to some extent, some of the same things going on in the property types, but doesn't quite have the fundamental underlying growth story that the U.S. still has, and that makes it, at least in my opinion, trickier. Asia, which we don't do much in, as at Clarion, is a very widespread region. It has some core markets that would function a lot like the US as far as quality, like Australia, for example, but they're just teeny tiny. And there are all sorts of parts of Asia that are really challenged in so many ways that you really can't look at them as institutional quality. And you'd want opportunistic returns for anything that you do.
Let's also talk about Brazil and Mexico for a little bit. What did you learn from your experiences over there?
Lots of different things. But let me start with the same kind of comment I just made about parts of Asia. So there's some really interesting, compelling, fundamental things going on in both Mexico and Brazil, but both of them are not yet really institutional markets. They don't have the same level of information. They don't have the same quality of people that actually do what we do. There are much more interesting challenges when it comes to government regulations and bureaucracy and business practices. At the end of the day, you've got to be really prepared to for a different environment than what exists in the US. If you just think you're going to take everything that all your procedures and the way you think and how you do things in the US and go down and do them in countries with very different underlying cultures and values, it's just not going to work. So there's a good reason why returns for assets in both countries are very high, even for core assets, because it's just not a fully safe feeling fundamental market. I'm saying that kind of nicely. Yeah. So, you'll learn a lot of hard lessons. You learn all sorts about different business. You try to do diligence the way you'd normally do here, and there are different issues that crop up that you would think of that would come up in the US. And, just as simple as like clarity of who owns the asset, right? And whether the seller actually has clean title, right? That's not so easy in places like Brazil. And that's just a fundamental thing here that you almost take for granted. Um, so you're not used to thinking about, well, what happens if they don't really own it, and somebody comes along and claims the asset after you paid a lot of money. So also the opportunities are much slimmer. They're much smaller markets. There are very few really major deep markets in either country. And therefore you have a limited playing field, and there's also competition, and you just got to be really careful about how you conduct your business, who you do business with, and don't kid yourself about how hard it is to get stuff done, because it's really hard. So
Would you say those make up predominantly for you majority of the added risk when investing over there, or is there some additional added risks that you guys have to calculate or factor into your portfolio construction?
well, in almost any part of the world, one thing that people would commonly look at is just as it's sort of in the risk category, it's not, but it's currency risk,
Yeah.
right? So and different investors have different attitudes about that. Some people hedge no matter what, right, back into their home currency, so that they kind of know what they're getting, and usually that costs a bunch and takes some out of your return. So if you're in Germany and you're going to go and you think a core IRR is 5 there, and you can go invest at the US at 6, but it costs you 200 basis points for hedging it, then you're down to 4, and it doesn't really make any sense, right? So, other people view investing across the globe as the hedge itself, right? So, hey, I'm really exposed to the US. Maybe I should be exposed to some other markets just in case they're better. So some investors take that point of view and don't hedge the deal, but view the investment across the globe as the hedge against other ones. That I think is a much more intelligent way of thinking about it. But people still pay attention to that currency risk. So if you're investing in Brazil, for example, which we did, and all of a sudden the currency goes against you, even if the asset does great, the returns look kind of lousy, or it could be the other way. So that's not something you think about when you're investing in your home country. Like, the rule of law and governmental risk is something we completely take for granted in the United States. Like, you cannot take that for granted almost anywhere else. Europe is pretty good. Canada's good. Australia's good. Japan's probably pretty good, but most of the rest of the world's not so good.
You had a long and impressive career. You've negotiated on so many different transactions and situations. What advice would you have for some of our members when getting into negotiation, whether it's for a real estate deal or maybe not even transactional?
Well, you're kind of negotiating all the time in many ways,
Exactly,
but
yeah.
in the way you mean the question, the real trick to me is really trying to understand what it is the other side's trying to achieve, and knowing what you're trying to achieve, and seeing if you can find the common ground, right? Because a lot of times people will posture or yell and scream or pontificate or whatever it is, and when you really parse down to, okay, what is it that you're really worried about, right? Tell us what you're really worried about.
Yeah.
Let's see if we can understand that. We'll tell you what we're really worried about. And there's almost always a way to solve that problem, as long as you're willing to listen to each other. So if you've got, the ability in your style to get to the point where you can really sort of say, okay, let's really talk this through and understand what each party's trying to achieve, that usually works. Now that doesn't work on like whether you want to pay 10 or 9 or 7 or 8, but
Yeah.
that's the simple part of the deal, is just getting to the point where you have an agreed price. That means you just went through a process and you kind of you want it, whatever reason. And, then the negotiation usually starts. And there's a buyer and seller negotiation. There's a negotiation between JV partners. So it's really in figuring out the issues that you need to figure out and how to, get around people's individual problems is part of the magic. So being able to listen and think through, being able to sort of like, come up with creative solutions is really valuable, right? As opposed to just saying, I got to have X, Y, and Z, and I'm a jerk, and if you don't do it my way, like, no deal, right? The second and only other lesson, the other thing I'll say at the moment is the most powerful thing in a negotiation is your ability to say no. In almost every deal, there's a point where like something comes up and the sides are entrenched, and you got to be ready to say no, right? Or have the other side believe you're going to say no, or believe when you say no that you really mean no. But that's a super powerful thing, right? And so you got to know where your limit is, stick to it, be disciplined about that, and say no when you have to say no.
Yeah.
Sometimes deals die.
Yeah.
Sometimes that magically, gets the other side. But that's a really powerful thing. And knowing when to say no, knowing when to try to be creative is part of the magic.
Could you also share with us some of the greatest lessons you've learned in real estate during your accomplished career? What are some of the mistakes you've made that our members can learn from?
Some of the best deals ever done are the ones you don't do. That's an interesting one to learn, right? And it's hard because sometimes you work really hard on deals and you want to do it. It looks great. It dies for whatever reason after just tons and tons of effort. But sometimes, if you kind of can't get there, there's frequently a good reason why. And, you realize that you kind of really dodged a bullet, by not doing that deal. So again, it goes back to being disciplined. If you don't like what you see, right, just say no, walk away, go find something else. The market's big and liquid and deep, and like there's plenty of other things to do. But probably some of the hardest mistakes are actually, that you live with are doing, it goes back to your joint venture thing, picking a joint venture partner you think is going to be great and they don't turn out to be so great, right? Or your asset thesis is kind of pretty bad and you didn't, you think it's great, but it's not so good. And, things go way against you. But some of the most disappointing personally have been people that seem to be very reputable, have done a lot of good things. You do a JV with them, and then you get extremely disappointed in their behavior down the road. So that just goes back to like, you really got to work hard to vet who you're going to do business with on the venture side, and make sure you're really aligned. You're never really going to know until you go through a difficult time with somebody. So it's a little bit of a guessing game until that happens, but try to do as much diligence as possible, because plenty of deals go right, but plenty of deals go wrong, and you got to learn how to deal with it when that happens. And I would say one last, and I know I'm talking a lot of generalities tonight, but to me, they're some of the most powerful things. Be very wary of investing in something you don't really know very well. We've made some investments, very, very early on. So call it data center 1.0, 20 years ago, right? One of them was actually in Somerville, on Annabelle Road in Somerville. And we knew, we know real estate, we know boxes, we know the major property types. We kind of thought it was hip and techy and cool, right? And we bought this data center over in Somerville, and we knew squat about the data center business. We didn't know anything about, really what was driving it, what did the tenants want, like what could possibly change technologically, and we got just crushed on that deal. when that technology and what the tenants wanted changed and that building wasn't so cool. So, and we convinced ourselves it was, not that it wasn't a real estate play, but we convinced ourselves it was a real estate play that where we understood the fundamentals and the tenancy the same way we did everything else, and we didn't, right? So I'd be really, you always got to be wary about weighing in to what you don't know. And now that's a really interesting thing today. When we talk about some of the new things out there, and we were talking about SFR, single family rentals, before the session really got started. And that's kind of a newfangled thing in a way, right?
Yeah.
But at the end of the day, it's housing, right? And we actually understand housing. Like, we know how to rent housing to people. We know how to run those. It's a little bit newfangled in its format, right? As individual homes as opposed to like an apartment complex. But, something like that, I think we can get comfortable because it operates much like every other kind of housing that we've operated, right? But there's some other property types that are a little bit different. We don't do things like cell towers, but plenty of people do. But do we really, until you really weigh into that space, how much do you know about that space? What makes a good cell tower versus a bad cell tower? Maybe they're all good. But so, I'd be wary about getting into a part of the real estate spectrum where you don't really kind of know exactly the dynamics and how it works, and because you're going to have some very painful lessons.
Thank you. And to wrap up the fireside chat segment of tonight, tell us, what lies ahead for you and for Clarion Partners?
For Clarion, that's reasonably easy. We still have a relatively small group in Europe, and we're really hopeful that we can expand that into a much more broad investing platform like we have in the US. Starting with some stuff we really know well, which is the industrial property type. So that's part of our growth. We think, some really great products inside the company that have plenty of room to run growth wise. So we got to keep doing those well and growing those. Like other people, we're expanding out into some of these other, adjacent property types like single family home rentals and stuff like that. That's a little bit of an opportunity to kind of grow and expand for us, since most institutional investors like us haven't done a ton of that. But that's an area of growth. And then lastly, I alluded to it before, but for the most part, our clients historically have been big institutional investors, and increasingly there are products and channels that are essentially funneling individual investors to us, right? And that's a ginormous space. So that's a real growth thing for our whole kind of institutional mindset real estate industry, is to accessing a really big pool of investor capital where we think we can provide good investment products to them. So that's interesting if you can do that. That's interesting growth. So we're focused on all that. And the real estate space, as I mentioned before, especially in the US, is in pretty good shape. Most of the firms are in pretty good shape. We've got lots of interest, so that's all good. And so we're enjoying that. So that's kind of what's, doing more of what we do and hopefully better is kind of what's up for Clarion. I am actually just got sent out there in the press this past week. I'm actually shifting off of the fund that I have been running for the last 10 years, and I'm taking over as the chief investment officer of the firm. So for me personally, that's going to be a cool new challenge. And I get to work with a lot more of our strategies in a much broader format. So I'm kind of looking forward to that. So that's my actual next step, which had we had this meeting a week ago, I wouldn't have even been able to say. So
very cool, Jeb, and truly congratulations and well-deserved to you. That's really exciting.
So you talked about kind of this divergence that we're seeing between, industrial and multifamily on one hand, and then office and retail on another. So how do you see like, the idea of creative conversion? So we were converting office buildings maybe into a multifamily building or a retail shopping center that's underused into like a logistics center for shipping. Do you see that as a successful investment strategy going forward?
It's much easier said than done. So, and if it was easier, you would see a lot more of it happening. So intellectually, market forces, it's a great idea, right? And in a city like New York, even a little bit in Boston, to tell you the truth, taking old office buildings and turning them into apartments has been something that's been happening for a while, right? And well located, downtown, urban, you can create some pretty cool housing out of office buildings. You can't go the other way, but you can do that. And that's much more common, but it's still much easier said than done. You're completely converting the way the space, inside the floors is laid out, and not every building is conducive to do that. You really kind of got to know what you're doing. But you'll continue to see that, especially where you have older office stock that's no longer really competitive as office space. And at some point it'll get to the get where like it makes economic sense to just repurpose it for in your example, multifamily. It would seem obvious to go to your other one that sure, we got way too much retail space, just rip down a whole bunch of malls and like put industrial there because we need a ton more of it. But very few of those are going on. Most places, most owners don't want to give up the ghost. Most jurisdictions view retail as much cooler than industrial. They much rather have retail in it and the vibrancy and, in theory, the tax revenue than having, industrial buildings with less workers and a lot of trucks and more traffic and blah, blah, blah. So it's really not easy. It's really very difficult, actually, to get a site that is available that the local jurisdiction is willing to rezone as industrial and therefore turn it into industrial from retail. You need a pretty big piece of land to begin with because industrial buildings are big and flat, they're big spread out. It's expensive to rip stuff down. So it's a cool idea, and it probably will happen a little more in the future than it has in the past, but so far there have not been many. And again, one of the big challenges is actually getting the approvals to do it, which again is not easy. So it's worth looking at them. We've done a couple. Generally, they work out pretty good if you get everything to line up. But my big answer to that is it's just not easy, right? Another one, you didn't ask this, but it's in the same vein. Like, life science is like the coolest thing ever right now, right? So, and everybody wants to turn their building into a life science building, especially office buildings, where office is kind of weak and challenged. And it's just not easy. Like most buildings aren't configured to be life science buildings, and nor are they kind of in the right locations and clusters. So once again, it's a cool idea and it seems obvious in some sense, but it's just very hard to do.
Jeb, it's been an absolute honor to have you here with us tonight. I couldn't thank you enough, and I just want to wish you nothing but continued success in you and Clarion's future. So thanks again, truly. Thank you.
Well, thank you so much for having me. I hope what I said was at least a little valuable, but it's really been a pleasure chatting with you guys tonight.